Hello everyone and welcome to my channel Compliance Lookup. In today's video, we will be discuss important topics money laundering and some its methods. Whether you're someone working in the finance industry, a student, or just someone interested in learning about how businesses protect themselves from financial crimes, this video is for you. These topics are essential for financial security, and in future videos we'll dive deeper into how these procedures are implemented, the tools used, and the real world impact they have on businesses and individuals. If you found this video helpful, don't forget to like, share, and subscribe for more content on financial compliance, regulations, and more. Now, coming to our main topic. Money laundering is the process of concealing the illegal origins of money earned through criminal activities such as drug trafficking, fraud, corruption, or smuggling, and making it appear as though it came from legitimate sources. The main goal of money laundering is to hide the illicit nature of the money so that it can be used within the legal financial system without raising suspicion. To achieve this, criminals often move dirty money through a series of complex transactions involving banks, businesses, or even international transfers to obscure its origin. Key characteristics: illegal source: the money typically comes from criminal activities like drug dealing, organized crime, human trafficking, or corruption. For example, drug cartels generate large sums of cash from drug sales and need to clean that money to use it openly. Concealment: the main objective of money laundering is to hide the illegal origin of the funds. Criminals do this by layering transactions, making it difficult to trace the money back to its source. For instance, someone may make multiple small deposits into different bank accounts to avoid detection. Complexity: laundering money often involves intricate financial systems, including the use of shell companies, offshore accounts, and cross border transactions. This complexity is meant to confuse investigators. For example, a criminal may transfer money through several countries under the guise of business payments, making it hard for authorities to follow the money trail. Global impact: in today's interconnected world, criminals exploit modern technology and globalization to launder money across multiple jurisdictions. This makes it easier to move money around and harder for law enforcement to track it. A real example is the infamous Panama Papers leak, which exposed how wealthy individuals and criminals used offshore companies and international banks to hide assets and launder money across borders. These characteristics make money laundering a global challenge as it enables criminal organizations to continue operating while damaging economies and undermining financial systems. Now we will discuss the basic money laundering cycle. It consists of three stages: placement, layering, and integration. Placement: this is the initial step where illicit funds are introduced into the legitimate financial system. Criminals deposit their dirty money in ways that avoid drawing attention. Common methods include depositing small amounts of cash into different bank accounts or purchasing high value items like luxury cars or expensive goods. For example, a drug dealer might deposit small sums of cash into various bank accounts over time, a technique known as smurfing, to avoid detection by authorities. Layering: in this stage, the money is moved through complex transactions to hide its illegal origins. Techniques used include transferring funds between multiple bank accounts, often across different countries, or using intermediaries such as shell companies or trusts that obscure the money trail. The goal is to make the money difficult to trace by creating a confusing web of transactions. For instance, a criminal may transfer funds between countries, disguising it as payment for consulting services or other fictitious business dealings, making it harder for law enforcement to trace its origin. Integration: finally, the clean money is reintroduced into the legitimate economy. At this stage, the money appears legitimate and can be used without raising suspicion. Common methods of integration include investing in legal businesses, purchasing real estate, or high value assets like art or luxury properties. For example, after going through layering, a criminal might use the laundered money to buy a luxury property or invest in a legitimate business, making it appear as though the funds came from legal activities. These three stages help criminals blend illegal funds with the legal economy, making it harder for authorities to detect and seize their ill-gotten gains. Now let's coming to the role in preventing money laundering. Bankers are on the front lines of the fight against money laundering and must be vigilant in spotting suspicious activities. Here's what they need to focus on. Understanding red flags, bankers should be aware of typical warning signs of money laundering. For example, if a customer makes large cash deposits without a clear source of income or conducts high value transactions that are inconsistent with their profile, these could be indicators of illegal activity. An example could be an account normally used for small retail business transactions suddenly receiving large international wire transfers, raising suspicion. Adhering to know your customer, it's crucial for banks to properly identify their customers and understand the nature of their business. This helps ensure that all transactions are legitimate. For example, a banker may need to investigate the source of funds. If a customer involved in a low income business suddenly makes a multi-million dollar investment, which doesn't match their known financial profile. Compliance with AML regulations, banks must stay updated with both local and international anti-money laundering AML laws. They should implement systems to monitor transactions and identify suspicious activity. This could involve tracking patterns like structuring where a customer makes multiple small transactions to avoid reporting thresholds. If a bank in the US notices a customer splitting $20,000 into several deposits under $10,000 to avoid triggering a report, it must file a suspicious activity report (SAR). Training and awareness, bank staff should undergo regular training to stay informed about the latest money laundering techniques and trends. For example, newer methods may involve cryptocurrencies, and training would help staff detect unusual crypto related transactions that may indicate laundering. Collaboration with authorities, bankers should cooperate with financial intelligence units, FIAs, and law enforcement agencies by providing data and documents as needed. For instance, if law enforcement is investigating an account linked to terrorism financing, the bank must promptly provide transaction records or other requested information. Real world example, in 2012, HSBC was fined $1.9 billion for failing to prevent money laundering by Mexican drug cartels. The bank had allowed large cash transactions and ignored warnings, highlighting the importance of understanding red flags, adhering to AML regulations, and working closely with authorities. Now, coming to key features. First, dual sources. Terrorism financing can draw from both legitimate sources such as donations or businesses and illegal activities like drug trafficking, smuggling, or fraud. For instance, a legal business might be used to generate profits, but a portion of that income is diverted to fund terrorism. Small amounts. Often, terrorist organizations do not need large sums of money. Small amounts spread over time are enough to fund operations or specific attacks, making detection harder. For example, terrorists may use small online donations to gather funds without triggering suspicion from financial institutions. Global reach. Just like money laundering, terrorism financing has a global scope. Terrorists often use international networks and transfers to move funds across borders, complicating efforts to trace the money. This global reach allows terrorist groups to tap into a wide range of funding sources across multiple countries. Diverse methods. Terrorist groups use a variety of methods to collect and transfer funds. These methods include using charities, businesses, or even crowdfunding platforms. They might disguise the money flow under the pretense of legitimate causes, like disaster relief or social services. Disguised purpose. Often, the true purpose of the funds is hidden. For example, a charity might be raising money for disaster relief but is secretly diverting a portion of the donations to support terrorist activities. The donors might not even be aware that their contributions are being used for illegal purposes. Let's take a real example. A well known example of terrorism financing involved the charity Al Qaeda in the Islamic Maghreb. The organization collected donations under the guise of humanitarian aid for refugees, but was secretly funneling the money to fund terror operations. Innocent donors believed they were supporting a good cause, unaware that their money was being used to finance terrorism. This highlights the dangers of terrorism financing, where legitimate looking entities or causes are exploited to gather funds for violent and illegal activities. Let's understand financing of terrorist acts. Terrorist acts, such as bombings, targeted attacks, or larger scale operations, require significant financial resources. These funds are needed to procure weapons, explosives, transportation, training, and logistical support. In addition, money may be allocated for recruiting, communication, and propaganda efforts to further spread the group's ideology. One of the key tactics used by terrorists is to conceal these financial resources within seemingly legitimate transactions, such as donations to charities, payments for goods and services, or support for community projects. This tactic makes it difficult for authorities to distinguish between lawful and illicit transactions, allowing terrorist financiers to move funds undetected. Example: in a conflict zone, a terrorist group could fund the purchase of weapons by disguising the payment as a legitimate transaction for construction materials. Given the region's instability, where large sums of money are exchanged for rebuilding efforts, it becomes challenging for law enforcement agencies to track which payments are for legitimate purposes and which are funding terrorism. The flow of money for construction materials could easily mask the actual purchase of firearms or explosives. Next, financing of terrorists. Financing isn't limited to funding individual terrorist acts but extends to the ongoing sustenance of terrorist organizations over time. These funds support not only operations but also the daily needs of terrorists and their networks. Financing is used to pay salaries to members, cover living expenses, and fund recruitment drives, propaganda efforts, and training camps. Terrorist organizations rely on a steady stream of financial support to maintain their network and grow their influence. In many cases, personal support is provided directly to individual terrorists, disguised as personal gifts, loans, or charitable donations. This support ensures that operators remain loyal and are financially secure while planning or executing attacks. Example: a terrorist organization may provide monthly financial support to a suicide bomber's family as an incentive. The group promises ongoing financial security to the bomber's family, ensuring their loyalty and motivating others to follow the same path. In this way, financial incentives are used not only to support the immediate act of terrorism, but also to sustain the broader network by encouraging others to join and commit to similar acts. These forms of financing enable terrorist groups to operate with greater sophistication, using complex methods to hide the origin of funds and sustain their activities, making it increasingly difficult for authorities to prevent and detect the movement of terrorist finances. Now, coming to learning for bankers. Bankers and financial institutions play a key role in identifying and preventing terrorism financing. To do so, they need to be vigilant and focused on detecting suspicious transactions that may indicate the movement of funds to support terrorist activities. One of the primary tasks is identifying red flags, such as frequent small transfers to high risk countries or conflict zones, which are often used to move funds discreetly. Additionally, transactions that are inconsistent with the customer's usual financial profile like a sudden increase in international transfers, should be carefully examined. Charitable donations to organizations in conflict areas are another red flag, as some charities may serve as fronts for terrorist groups. Lastly, sudden withdrawals or fund transfers with no clear reason can be a sign that funds are being redirected for illicit purposes. Another crucial aspect is know your customer, which involves thoroughly verifying a customer's identity and the source of their funds. Understanding the purpose of transactions, particularly those linked to high risk areas, helps prevent the financing of terrorism. Financial institutions should monitor accounts for suspicious activity, such as unusual international transfers or transactions to areas known for terrorist activity. For example, a financial institution might notice that a customer has been making regular small payments to a region with known terrorist groups, which could be indicative of terrorism financing. By focusing on these red flags and maintaining a strong KYC process, banks can detect and prevent the flow of money used for terrorist acts. An example of this could be the case of a charity raising funds for disaster relief, where the funds were secretly funneled to terrorist organizations. Had the financial institution recognized the red flags, this activity could have been intercepted. Compliance with anti terrorism financing, or can say ATF regulations. Banks and financial institutions must ensure strict adherence to both local and international anti terrorism financing (TF) regulations to prevent the flow of funds to terrorist activities. This involves implementing robust systems to detect and report suspicious transactions through Suspicious Activity Report (SARS) or Suspicious Transaction Reports (A*STARS) to the relevant authorities. In addition, bankers must be aware of sanctions lists and ensure that their customers or the beneficiaries of transactions are not linked to blacklisted entities or individuals associated with terrorism. Compliance with these regulations is crucial to blocking the financing of terrorism. Regular training and awareness are also essential for ensuring that bank staff can recognize potential signs of terrorism financing. Bankers must be trained to identify emerging techniques used by terrorists to raise funds, whether through legitimate or illegal sources. Keeping up to date on the latest trends, regulations, and red flags is key to detecting suspicious activities before they escalate. For example, if a customer begins wiring large sums of money to a high risk country, claiming it is for charitable purposes, but the charity has no established history or reputation, it should raise immediate concerns. In such a scenario, the banker should investigate further, and if the transaction appears suspicious, it should be reported to the authorities. A real world example of this occurred in 2019 when a series of suspicious transactions involving donations to non governmental organizations (NGOs) in conflict zones were flagged by a bank, leading to an investigation that uncovered terrorist financing through fake charity fronts. In this case, the timely intervention of the bank's compliance team prevented further illegal transfers. By following these procedures, banks help prevent funds from reaching terrorist groups and protect the integrity of the financial system. Now, coming to tax evasion. Tax evasion refers to the illegal act of avoiding taxes that are legally owed by either underreporting income or hiding it completely. This practice results in the creation of black money, which is income that is not disclosed to the tax authorities. To simplify, think of it like when someone tells their parents they earned less pocket money than they actually did so they can keep the extra for themselves. Similarly, individuals or businesses conceal their true earnings to pay less tax. For example, if a business owner earns $100,000 in a year but reports only $50,000 to tax authorities, the unreported $50,000 becomes illegal or black money. This is a criminal offense and harms the economy by reducing the government's revenue. Now, coming to methods modes used for money laundering terrorism funding. Here are two key methods: using normal banking services. A. Deposit structuring. Smurfing criminals break down large sums of money into smaller deposits to avoid detection. For example, depositing $9,000 into several accounts instead of one large deposit prevents triggering the bank's $10,000 reporting threshold. This way, the illegal origin of the funds remains hidden. B. Multiple tiers of accounts. In this method, criminals move money between different banks or countries, creating multiple layers of transactions. This complex web makes it harder for authorities to trace the original source of the funds. For instance, a person may transfer money through several accounts in different countries, making tracking nearly impossible. These sophisticated tactics help criminals move and hide illegal funds, complicating law enforcement efforts to combat such activities. C. Funnel accounts. Funnel accounts involve setting up bank accounts in multiple locations where small sums of money are deposited, and later all the money is transferred to a central account. This method is commonly used in terrorism financing. Example, suppose individuals from different cities deposit small amounts like $500 or $1,000 into separate accounts. These funds are then funneled into one central account. This makes it difficult to trace where the money came from originally, especially when the amounts are small and appear as donations or payments. D. Contra transactions. In this method, criminals offset payments between different accounts, countries, or currencies to obscure the origin of the funds. It's like creating a balance of debits and credits, so it becomes tricky to follow the actual money trail. Example, a criminal makes a payment in one country, but an equivalent amount is credited in another country. This makes it challenging for authorities to track the movement of funds since the original transaction gets balanced by another, appearing as if no real movement happened. E. Bank drafts and similar instruments. Money launderers or terrorist financiers often purchase bank drafts, money orders, or similar instruments using cash. They then deposit these instruments into bank accounts, making the money appear legitimate. Example, a criminal might buy a bank draft in one country using cash gained from illegal activities. They then deposit this bank draft into an account in a different country, which makes it seem like the money is clean and from a legitimate source. Each of these methods is designed to hide the origin and movement of funds, making it harder for authorities to trace illegal money. Here are detailed explanations of more money laundering techniques. F. Cash deposits followed by transfers. In this method, large sums of cash, often from illegal activities, are deposited into a bank account and quickly transferred to another account or country. The goal is to distance the money from its illicit source, making it harder for authorities to trace it back to the crime. Example, a drug trafficker deposits $100,000 in cash into a local bank. Immediately after, they wire the money to a foreign bank account, possibly in a country with lax financial regulations. This swift transfer helps conceal the cash's illegal origins and complicates law enforcement's efforts to track it. G. Connected accounts. Criminals may use several accounts that are connected through shared ownership or control to move money easily between them. These accounts are often held by shell companies, which are companies that exist only on paper with no real business operations. Example, a criminal sets up multiple shell companies, all owned by the same person or group. They then move money between these interconnected accounts, creating a confusing network of transactions. This method makes it difficult for investigators to pinpoint the original source of the illegal funds, as the money seems to circulate through legitimate businesses. H. Front companies. Front companies are legitimate looking businesses that criminals use to mix illegal money with legally earned funds. By doing so, the illegal money appears as part of the company's legitimate revenue, making it hard to detect. Example, a criminal operates a laundromat or restaurant as a front business. While the business does earn real income, the criminal mixes illegal money from drug sales into the company's daily cash flow. Since laundromats and restaurants often deal with large amounts of cash, it becomes easy to disguise the illegal funds as part of the business's legitimate earnings, making it hard for authorities to distinguish between the two. These methods of laundering money enable criminals to obscure the illegal origins of their funds, making it challenging for law enforcement to detect and trace the illicit money. I. Legitimate accounts. Criminals often exploit legitimate accounts owned by innocent individuals or businesses to launder money, sometimes without the account holder's knowledge. For example, a criminal might deposit illicit funds into a legitimate charity's bank account, making the money appear as a donation. By doing so, the criminal can disguise the illegal origin of the funds. The charity may have no knowledge of the crime, and because it is a legitimate entity, the transaction may not raise any suspicion, allowing the criminal to move the money without detection. J. Dormant accounts. Dormant accounts, or those that have been inactive for a long period, can be reactivated by criminals for the purpose of money laundering. These accounts typically aren't subject to frequent scrutiny because they have been idle, making them an attractive target for illegal activity. For instance, if a personal account that has been unused for years suddenly receives a large sum of money, and then that money is quickly transferred to another account or withdrawn, it may raise suspicion. However, because the account hasn't been active for so long, it may avoid immediate detection, enabling the criminals to move funds more easily. K. Wire transfers. Wire transfers are often used by criminals to move large sums of money across borders because they are fast, and once the money leaves one country, it becomes harder to trace. Criminals, such as those involved in terrorism financing, frequently use wire transfers to disguise their illicit activities. For example, a terrorist financier might wire money from a country with lax financial regulations to another country under the guise of a legitimate business transaction, such as a payment for goods or services. Because wire transfers can quickly move money across multiple jurisdictions, they make it difficult for authorities to track the true purpose and origin of the funds, facilitating money laundering and financing of criminal activities. Using special accounts for money laundering terrorism funding. A. Collection accounts. A collection account is a type of account where funds from multiple sources are pooled together, making it difficult to trace the origin of the money. Criminals use these accounts to gather funds from illegal activities and then transfer the money to other accounts, making it look legitimate. By combining money from different sources, they obscure the origins of the funds and make it harder for authorities to track the illicit money back to its original source. Example, a group of criminals involved in drug trafficking sets up a collection account. Funds from drug sales, illegal gambling, and other unlawful activities are deposited into this account. Once the money accumulates, they transfer it to offshore accounts or legitimate looking businesses, making it appear clean. By pooling the funds in one account, they make it nearly impossible for investigators to trace each deposit back to its specific illegal source. B. Payable through accounts PTA. A payable through account is typically set up by a business, but the funds in the account technically belong to third parties, such as the business's clients. These accounts allow criminals to make payments on behalf of their clients while keeping the true sender or recipient of the money hidden. PAs are often used to move large sums of money across borders, making it harder for authorities to track who is behind the transactions. Example, a criminal organization sets up a fake import export business and creates a payable through account under the business name. They use this PTA to move money internationally, appearing as though the funds are for legitimate business transactions. In reality, the funds are being transferred on behalf of criminals. hiding their true identities and involvement in the illegal transactions. These methods allow criminals to exploit the financial system by using special accounts that help hide the origin and true purpose of illicit funds, making it harder for law enforcement to track the flow of money in criminal activities. Using cross border trade loans, we will see back to back loans. Back to back loans involve two loans arranged between parties in different countries to mask the movement of funds. Typically, a loan is taken out in one country and another loan is issued in a second country, with the two loans offsetting each other. This technique makes it difficult for authorities to trace the flow of money and allows criminals to move funds across borders without raising suspicion. Example, a company in country A takes a loan from a foreign subsidiary in country B. In return, the parent company in country A provides a loan to the subsidiary in country B. This creates a circular transaction that looks legitimate on paper but is actually being used to move illicit funds across borders while evading detection by regulators in both countries. International trade and trade finance. Criminals can exploit international trade transactions to launder money by falsifying the value, quantity, or existence of goods and services. By over or under invoicing trade shipments, they disguise illicit money as legitimate payments. This method often involves trade based money laundering, where false invoices or misrepresentation of the goods value allow money to be moved across borders under the guise of legitimate business. Example, a company involved in drug trafficking exports goods to a foreign country but inflates the invoice by 50%. The buyer in the foreign country pays the inflated amount, which includes the illegal proceeds, making it appear as a legitimate transaction. This extra money is funneled back to the criminals, disguising the proceeds of their illicit activities as trade income. Now, using entities in lax jurisdiction. Offshore banks. Offshore banks are located in countries with lenient financial regulations and are often used to hide illicit funds. These banks provide secrecy and make it easy to move money without much scrutiny. Criminals exploit these banks to avoid taxation, oversight, or legal consequences. Offshore jurisdictions often have minimal reporting requirements, making it difficult for law enforcement to track the origin or movement of money. Example, a business involved in illegal arms trade deposits profits into an offshore bank located in a country with weak financial regulations. The offshore bank helps the business keep its assets hidden from authorities, allowing the criminal organization to move its money freely without being tracked. Shell companies. Shell companies are entities that exist only on paper and have no physical operations or employees. Criminals use shell companies to conduct financial transactions while hiding the true ownership of assets. By setting up shell companies in jurisdictions with lax regulations, criminals can obscure their involvement in illegal activities and make it harder for authorities to trace the money back to them. Example, a corrupt politician sets up multiple shell companies in tax havens. These companies are used to move bribes and other illicit money without revealing the politician's involvement. The shell companies transfer funds between each other, creating a complicated trail that is difficult for law enforcement to follow. Using cards remittance products, credit and debit cards. Criminals use credit and debit cards to facilitate money laundering by making payments or withdrawals in small amounts. By spreading transactions over multiple cards and accounts, they avoid detection from regulators and banks. Small transactions are less likely to trigger red flags, making it easier to move illicit money. Example, a criminal organization uses dozens of prepaid debit cards, each with a small amount of money, to withdraw funds from ATMs in different countries. The total amount adds up to a significant sum, but each individual transaction appears small and legitimate, making it difficult for authorities to detect the illicit nature of the withdrawals. Bureau de change money changers. Money changers or bureaus de change often serve as intermediaries in transferring money across borders. These establishments convert cash into foreign currencies, and in some cases, criminals use them to launder money. Since some money changers do not adhere to strict documentation requirements, they can be used to transfer illicit funds across borders with minimal oversight. Example, a drug cartel uses a bureau de change to convert large amounts of cash into foreign currency. The bureau de change does not ask for proper documentation, allowing the cartel to transfer the money abroad without drawing the attention of authorities. This technique allows criminals to avoid the more regulated banking system and move money anonymously across borders. These sophisticated methods allow criminals to launder money across countries and obscure the source of their illicit funds. Through the use of international trade, offshore entities, shell companies, and remittance products, they make it harder for law enforcement to detect and trace illegal activities. Using other remittance service providers. Remittance services. Remittance services enable individuals to send money across borders, often targeting regions where access to formal banking systems is limited. These services are sometimes exploited by criminals to transfer illicit funds. Since these transfers are often difficult to trace, they provide an easy way for money launderers or terrorist financiers to move money without triggering regulatory oversight. Example, a criminal organization involved in human trafficking uses a remittance service to send small sum money from one country to another, avoiding traditional banking systems that have stricter reporting requirements. These small transactions add up to large sums, but are difficult for authorities to detect due to the decentralized nature of remittance providers. Alternative remittance systems value transfer systems. These are informal methods of transferring value outside the formal banking system. One well known system is the Hawala network, commonly used in the Middle East and South Asia. Hawala transactions occur based on trust, without money physically moving across borders, making it extremely difficult for authorities to monitor or trace. Example, a person in the US who needs to send money to a relative in Pakistan contacts a local Hawala broker. The US broker contacts a counterpart in Pakistan who gives the relative the equivalent amount of money. The funds never leave the US but have effectively been transferred. This method is often exploited by criminals to send illicit money across borders without triggering alarms in the formal financial system. Hawala system. The Hawala system is a centuries old, informal way of transferring money through a network of brokers hawaladas. The system operates on trust and bypasses traditional banking channels. Criminals may use Hawala for money laundering or terrorism funding, as it offers anonymity and is difficult to track. Example, a drug dealer in Europe wants to send illegal proceeds to the Middle East. Rather than using a formal bank transfer, they contact a Hawala broker who facilitates the transfer by informing another broker in the Middle East. The funds are paid out to the recipient, but no official record of the transfer exists. This makes it very hard for law enforcement to detect or stop. Using third party products and new technology. Insurance policy. Criminals use insurance products such as life insurance or investment linked policies as a means of laundering money. Premiums are paid in one country and the policy is then surrendered or cashed out in another country. This makes the funds appear clean and legitimate even if they originated from illegal activities. Example, a corrupt business person purchases a life insurance policy with large premium payments using illicit funds in country A. After a few years, they surrender the policy in country B, receiving a large payout that appears to be legitimate even though it is laundered money. Emerging technologies. New technologies such as mobile wallets, online payment systems, and peer to peer lending platforms are increasingly being exploited by criminals. These platforms offer a level of anonymity and allow money transfers with minimal regulatory scrutiny. Peer to peer lending or digital wallet services can make it easier for criminals to disguise the origin of their illicit funds. Example, a money launderer transfers funds through a mobile payment app that allows anonymous transactions. The money is transferred across several accounts, blending legal and illegal funds. The anonymity provided by the app makes it difficult for authorities to trace the transaction back to its source. Cybercrime cryptocurrency. I. Cybercrime. Cybercrime such as hacking, identity theft, and fraud is often used by criminals to steal funds and transfer them in ways that are difficult to detect. Cybercriminals may use these stolen funds to make online purchases or move the money through digital accounts, making it hard to trace back to the original crime. Example, a hacker steals credit card information and makes several purchases through online platforms. They then sell the purchased goods for cash, effectively laundering the stolen money. The cybercrime allows them to avoid traditional banking systems, making the crime harder to trace. II. Cryptocurrency. Cryptocurrencies like Bitcoin and Ethereum are increasingly being used for money laundering. These digital currencies offer decentralized networks that make it difficult for law enforcement to trace transactions. Since many cryptocurrencies provide anonymity, criminals can transfer large sums without triggering the same reporting requirements as traditional bank transfers. Example, a drug cartel receives payments in Bitcoin for its illegal operations. The Bitcoin is then transferred between multiple anonymous wallets, making it nearly impossible to track the original source of the funds. Later, the Bitcoin is converted into traditional currency through a cryptocurrency exchange that does not follow strict reporting guidelines, allowing the cartel to clean its illegal profits. These techniques leverage emerging technologies and unregulated financial systems, making it challenging for law enforcement and regulators to detect and trace illegal money transfers. The growing use of informal and digital methods for money laundering presents significant challenges for authorities around the world. Sensitive avenues for money laundering, terrorism financing, gold diamond markets. Gold and diamonds are attractive avenues for money laundering because they are high in value, easy to transport, and can be bought or sold discreetly across international borders. These commodities act as an alternative currency in many illegal activities. Criminals and terrorist groups often purchase gold and diamonds with illicit funds and then sell them for cash or other goods, allowing them to turn dirty money into clean assets. These transactions often go unnoticed due to the high demand and lack of transparency in certain gold and diamond markets. Example, a criminal organization involved in drug trafficking purchases diamonds with money earned from illegal activities. They then sell these diamonds to legitimate buyers in a foreign country, receiving clean money in return. The proceeds from the sale of the diamonds are now viewed as legitimate funds, successfully laundering the money. PEP's politically exposed persons corruption. Politically exposed persons PEPs are individuals with significant power or influence, such as government officials, heads of state, or high ranking military officers. Due to their positions, PEPs are at a higher risk of being involved in corruption, such as accepting bribes or kickbacks. Criminals may exploit the influence of PEPs to move illegal funds through political or government channels. PEPs may use their authority to mask the illicit origin of funds, disguising them as legitimate earnings or investments. Through bribes or manipulated contracts, the money can be funneled into international accounts, making it appear as legitimate income. Example: a government official receives a $1 million bribe from a company in exchange for approving a lucrative contract. To hide the source of the bribe, the official channels the money through several international bank accounts, registering the funds as business payments or consultancy fees. This layering process makes it harder for investigators to trace the funds back to corruption. Misuse of non-profit organizations charities. Non-profit organizations and charities are sometimes exploited by criminals or terrorist organizations as a front for illegal activities. While most non-profits and charities are legitimate, some are set up or infiltrated by criminal groups to receive and divert funds for illicit purposes. In this process, donors, including well meaning individuals, may unknowingly contribute to organizations that funnel money to criminal activities or terrorist financing. The misuse of these organizations is challenging to detect due to their seemingly legitimate and humanitarian nature. Example: a charity is established to raise money for humanitarian aid in a conflict zone. While the charity collects millions in donations, a portion of the funds is secretly diverted to finance a terrorist organization operating in the region. The charity provides a cover for the illegal movement of money, and donors are unaware their contributions are funding terrorism instead of helping the affected people. These avenues present significant challenges for law enforcement and regulatory agencies because they involve areas where large sums of money can move discreetly, and their legitimate fronts make it difficult to distinguish between lawful and unlawful transactions. So, we have completed our second chapter of money laundering and some methods. Now, in the next video, we will discuss in money laundering and its global measures in detail. So, thanks you for watching this video.